Money Vikings, welcome back. Money Viking G here. The Mandalorian, this is the way. I want to share a very critical one for you investors out there today. Okay, enough of the Mandalorian gimmicks. I heard the movie was awful or just like not good. I don't know. We'll see. I'll probably see it when it comes out on streaming or something. I'm not going to see it in the theater. Although I wanted to. I like The Mandalorian, but I heard the movie is not good. So, oh well. Disney, what are you doing with Star Wars? Don't ruin it. You guys got to get your heads straight. This video is not about that, though. This video is not about The Mandalorian. This video is about the 4 or 5, I'm calling them investment vehicles, investment longboats, investment accounts that successful investors have. And this is from experience, and this is from research, and I'm going to explain why the different accounts are important and why they synergize off of each other, and so how you want to build the various accounts over the years. So the first one is what I call the foundational account, and this is where I think most people should start. Although I don't give investment advice, we don't give investment advice, but I do financial coaching. And I do share what has worked very well over the years and what will probably continue to work very well. I'm going to explain these various investment accounts and why they're important. These are the top 5. So the first one is your traditional 401k or self-directed IRA. And this is what I call the boring account. Number 1 is the boring account. And the boring account will not be boring in the out years. After 20 years, after 15, 20 years, it will not be boring. It'll be very exciting. But it's very boring in the beginning, and it should almost be so boring that you forget you have it. But what it is it's that typically people have them through their employer, and hopefully a person has a match, a company match, or a government match, or whatever their 401k situation is. They have some kind of match. And I know that is not as common as we'd like it to be. I wish every worker had access to something like this. I think every worker deserves access to something where there's a match. I think there'd be a huge incentive for people to invest if they got a match. Because first of all, with a match, a lot of places they match up to like 6%. I haven't heard of many that do beyond that. And a lot of times it's the first 3% is matched dollar for dollar. Every dollar you put in, the employer or the government puts $1 in, and then everything beyond that up to like 5 or 6%, they put 50 cents on the dollar. But right away, that's a 100% return on your money, which is almost unheard of. So that's the very first account. And so if you don't have it through your employer, you got to do a self-directed individual retirement account or IRA. Very easy to open. You can open one through Fidelity, Vanguard, Schwab, all the big names, and there's tons of others that have very low fees. That's the critical thing about this account, is that it has low fees, and it's automated, and it's diversified properly and simply, quite simply. And in my opinion, in my view, this should be something like when you're a younger worker, it should be like 70, 80% in an S&P 500 index, and maybe 20% in a bond fund. If you want to diversify a little bit more beyond that, I'd say maybe throw in an international fund. So maybe it's 50, 60% S&P 500. Maybe it's 30% of an international fund. And the remaining 10, 20% is a bond fund. And basically, I would just dollar cost average, put money into that at some percentage of your paycheck every 2 weeks. And I would essentially, after that, just forget it exists. Frankly, I really would. I think that would be the best long-term plan. Don't mess with it. Don't monkey with it. The fees have to be low. Don't do something with big fees. You can find low fee. Very simple thing. You have it automated, so you're getting the human element out of it. You're not becoming a stock picker, and you're done. Okay. And don't worry, I'll get to the exciting stuff for you stock pickers out there. There's something for everybody here. But that's number 1. That's the foundation. And it should be boring, forgettable, and I'm exaggerating a little bit, but forgotten. Okay, that should just ride. So that's number 1. Okay, the second part of that is, after that's gone for a few years, is building putting some of that to work in a Roth IRA. So then contributing to a Roth IRA. That's where you're paying the tax up front. And in the future, 10, 20, 30, 40 years, 50 years later, that money is withdrawn tax-free. So that's the second fundamental investment account I would have, is a Roth IRA investment account that supplements that first boring account. The Roth should be boring as well. Just dollar cost average into it, some percentage. Personally, I would just put it in the SPY, S&P 500 index, and I would just let it ride. So there's that one. Are there going to be down years? Yeah, there's going to be down years. There's going to be a lot of up years too. There's going to be some down years and there'll be some up years. Okay. All right. So those two are foundational. Okay. Number 3 gets a little more interesting. So the third one I would have is a traditional brokerage account where you are mainly focusing on maybe a few stocks, big names like a Berkshire types, and then ETFs. And what I mean by this one is this third brokerage account is going to go into more specialized ETFs, right? These are things where you're going to get your access and your exposure to AI specific ETFs, if that's something you're interested in, think is going to grow. Your energy specific, your semiconductor specific. Maybe you want to go into defense, technology, space, consumer, consumer fundamentals, whatever consumer ETFs. Maybe you want to go into some like specialized, pharmaceutical type things or genomics, whatever it might be. But this is going to be, a little more risky, but it's going to be trying to harness the power of some of these macro trends like AI and other things like that. So that's number 3. That's a brokerage account, which is going to be mainly ETFs. I'd also throw in things like, I like everybody knows I like the VDATX, the VIG, the Vanguard Dividend Fund. There's the Schwab Dividend Fund, but that kind of stuff, right? And then maybe there's a few stocks in there that you want to add to over time and you just, maybe you just believe in or whatever, okay? So that is the next account, okay? And these kind of go from low risk to higher risk, okay? So the next one, number 4, is this is the mad money kind of going with just like, I don't know if I want to call it meme stocks or stuff you're hearing from YouTube gurus or TikTok gurus or whatever, talking heads online that are saying, this one stock is the next big thing, GameStop is going to blah, blah, blah. Bloom Energy is the next thing to buy, Bitcoin, whatever it might be. So this is going to be like what I would say like a Robinhood account, but it's like play money. I would keep it at, less than 5% of your overall assets. But what I found about this account is that when you see, we're all going to get exposed now to these TikTok shorts and these YouTube shorts and all these financial gurus if you're into this stuff. And they're going to talk about the latest stock. And so this is one where you can throw a few $100, few $1,000, whatever it might be, into that latest thing. SpaceX IPO, Rocket Lab, whatever. It's just something that is interesting to you. And you want to try it. It can be a conservative investment. It can be a non-conservative, but it's going to be individual stocks and you're going to put it in there and see how it goes. Right. This is the mad money, and that money where you're kind of chasing that sort of like feeling of, it's probably it's like a FOMO fund in a lot of ways. It's like a FOMO fund. So if you're missing out, you're going to put money in there. But at the end of the day, you've got those other 3 working for you in the background, and they're solid foundations. And this is kind of like a pyramid, right? So it goes up into less and less. And this is less of your money, less of your capital. But you can kind of get that feeling out of that kind of, it's a little bit day trading type. It's not day trading per se. I don't like day trading, but it's more quick trading probably. A lot of this is, if something does shoot up based on some social media, something, maybe you're just going to take the profits and it's going to be your fun money. Maybe that's your beer money. Maybe that's your go to Las Vegas money, your trip money, go to Hawaii. buy something crazy, buy some magic cards, buy a comic you wanted because you made some extra money. But it's not going to be a threat to your long-term stability. So, but it gets that feeling of gambling out of you, whatever it may be. So that's the next one. The fifth one, even more risky, is a crypto account. So maybe this is a Coinbase, a Kraken, whatever it might be. But this is, again, I would keep this, as I've always said, I'm, 1 to 2% of overall assets. And, you're playing with the Ethereum, the Bitcoin, whatever else. I'm kind of out of it now, like Ripple. I know there's so many, there's like thousands of these damn coins, and I'm not really that interested in anymore. I mean, I still have some Bitcoin. I like Bitcoin, a little bit of Ethereum maybe, and a couple cats and dogs, but I'm not that interested in the cats and dogs. It's like, let's see how the Bitcoin thing plays out. But yeah, there's then a crypto, sort of a crypto area. So those are the 5 vehicles, 5 types of accounts that I would have, and I think make for a very overall well-rounded approach to investing. And you kind of get the best of all worlds with that approach. And again, it's like a pyramid. The first one I mentioned, the 401k, the IRA, that's like the foundation. Then you have the Roth IRA, then you have the brokerage account, then you have maybe the Robinhood type thing for the individual meme stock trades, and then you have the Coinbase or whatever, Kraken, for some of the Bitcoin or the other crypto that you're working on. Okay, so all that I think should also be underpinned by some kind of real estate exposure. And I do believe that can be your own home, which is a consumable. It is expensive. But the reality is a lot of people build large amounts of wealth over decades in real estate and in their primary residence. Now, I believe, obviously, in going outside the primary residence and investing in all kinds of real estate. But at the end of the day, for the average person, average investor, they're going to do fine by having their 401k and a piece of property. And that piece of property, the reality is going to be part of their net worth over time, and is going to build equity if it is a quality piece of property in a quality town, in a quality part of town. It's going to have a lot of value. It's going to add a lot of value. So those are the 5 plus investment accounts that I would have. And yeah, enjoy. Okay, thanks for watching. Like and subscribe. See you next time. Happy Memorial Day, everyone.